Hello friends, welcome. Friends, today we are going to talk about a very important topic which is called expected inflation. Now friends, why I am discussing this topic today? It is because of RBI has released a report that is on 8 December 2023 on household inflation expectation survey. So this is a periodic survey RBI does every 2 months. So yesterday they came out with this report. So what I'm planning to do today is I'm going to show you the findings of this report and we can decide and analyze how our lives as citizens are going to be impacted because of this report. Whether there will be any impact or there will be no impact. Now before we understand this study, let's understand the definition of expected inflation. Now friends, there is a difference between inflation and expected inflation. Inflation is what we encounter now in reality as we function in this economy, which basically means that whatever we were paying for goods and services today may be higher or lower depend upon the magnitude of the inflation. If the inflation is high, we will have to shell out more money for the same goods and services which you used to purchase earlier. Now, this is real inflation, right, which we are experiencing currently. Other is expected inflation, which basically means what inflation that we assume that we are going to or predict that we are going to face, let's say after 1 year, 2 years, 3 years, 10 years down the line. Now friends, why this is important? Why expected inflation is important? The reason expected inflation is important is because our behavior, what behavior that we encounter and we undertake in the economy right now today is driven by this term called expected inflation. And let me explain what I basically mean. Let's say friends that you are purchasing a bond. Now if you expect an inflation of 7% down the line, let's say after 10 years, and we are purchasing a bond, let's say for 10 years, you definitely not buy a bond with an yield of 6%. You will be foolish to do that because your expected inflation is 7%. So you will end up buying a bond or the yield which will be higher, right? 8% or 9% because you will definitely like to earn profit. You not like your money to get devalued as you purchase that bond. Similarly, for stocks also, it is slightly more complex. Your ability to earn profit or expectation of profit will be driven by what you perceive going to be the dilution of the money at that particular point of time. That is why expected inflation is very, very important. Now, expected inflation can be either lower or higher than the real inflation. Now, if the expected inflation is aligned with the real inflation, then there is no problem. Inflation as such is not that bad. What is bad is the shock that economy gets because of the surprise inflation which takes place in the market or which emanates out of the market, which is unexpected, which has not been predicted by the stakeholders functioning in the economy at that particular point of time. If there is a misalignment between the inflation, real inflation and expected inflation, then it is bad, and that basically creates more unexpected, more uncertainty, and it pushes the asset prices down. Because if there is uncertainty with inflation, then you will perceive more risk. When you perceive more risk, then what you will do, you will basically define a more higher spread for the assets that you are going to purchase, and the higher spreads are going to be added or get aggregated to the discounting factor. Higher the discounting factor, lower will be the valuation of the asset. So you will tend to value your assets much lower than the real price of those assets. So unexpected inflation is going to drive down the price of asset like stocks, bonds, etc. Everything will be driven down because of the risks that you perceive in the economy because of the uncertainty. And that is why it is very important to contain the inflation right at the point and nip it at the bud before it start to spread its tentacle. That is why inflation is bad. Inflation is bad because higher the inflation, more uncertain the inflation, expected inflation becomes. That's the reason why it is very important to contain our inflation, right? So given this background, let's go into the survey. So let's look at the survey. What is the finding of the survey is? Now, what summary is right in front of your screen. Summary says that there is a 20% decline in the current current inflation expected by the household, right? Which I'm going to show you in the chart. And 3 months, the household predicts that inflation is going to remain stable at 9.1%. However, the long-term inflation expectation has increased. Let's see what the results are. So let's go to the charts. So you will basically see what I'm talking about. Now this is a chart which I've created, which says this is a median value of inflation at a time scale of month starting from December 13 till November 23, which is the last day where till the survey was announced. Means this is the month which was evaluated. This is a period between September 23 to November 23. The last survey was evaluated within this period. Now, if you look at the current median, as the RBI says, it is 8.17% compared to the earlier number 8.397. So the current median numbers are lower. However, if you look at the 1 year median ahead, the numbers are higher, which is 10.07% compared to 9.92%, which clearly tells us that the household predicts a higher inflation going forward 1 year down the line. Now, friends, just to give you a practical example, whether it is really getting incorporated into the pricing of assets or not, let's look at the Indian bond prices, the government bond prices. I'm going to show you what the prices of Indian bonds are, right? So let's look at the numbers. I'm going to basically bring this particular chart in front of your in the screen. Look at this. Just a minute. And just may pull this. Yeah, look at this. So this chart this is basically coming from a website which is called investing.com. So look at this point. So what happened was that this is basically the price of 3 types of bonds. One is if you see here, this is basically this is the price of the bonds which are on 3 different metric. One is the current, another is 1 month ago, another is 1 year ago, right? And the bonds are of different duration, right? It can be 5 years, 7 years, 10 years. Now let's look at the 1 year duration of bonds. Now if you look at the 1 year duration of bonds, you'll find that the current price of 1 year duration of bond is 7.197% yield compared to 7.16% yield 1 month ago, or 1 year ago. The yield was 6.774%, which basically means that the investors are expecting a higher inflation 1 year down the line. That is the reason why the current prices of the bonds have slightly increased from what it was 1 month ago. Clearly, you can see that here, 1.16% versus 7.197%, which is exactly what you see here in this particular chart. You see that this is almost similar. So if you do the math, right, and you calculate the percentage increase, you will find this is basically for 1 year ahead median price. Around 2 months back, it was 9.92%. Now it is 10.07%. So if you do a percentage change, and you apply that to the bond prices, you will get almost approximately the same value. So this is basically giving you a reality check of the practical example as to how the bond prices get impacted because of expected inflation. Now let's go to some other charts, other data which kind of emanated out of this particular study. So let's go to this particular information, which is the prices of different types of product, which is again 1 year down the line. So because there are 2 different matrices by which these have been evaluated. One is 3 month, another is 1 year. So let's look at the 1 year products. Now if you see here, whatever was predicted by households for increasing of inflation by those 20 basis point, it's clearly reflected in this particular survey also. Like if you look at this chart, prices will increase. Now the earlier period, 82.8% of the respondents said that prices will increase, right? Now in this particular quarter, the survey, it says 86.1% of the people says that the prices are going to increase, which kind of resonates with what the household inflation numbers or the predictions that the study shows us. Similarly, if you look at the other numbers, price increase more than the current rate. This is also same. Price increase more than the current means what this particular row is telling us. These respondents are saying that the prices are going to increase more than the current rate. Earlier periods, 57.9% said that the prices are going to increase more than the current rate. Now, 63.2% are saying the prices are going to increase more than the current rate, which is higher than what the earlier quarter study reflected. Similarly, if you look at the other dimensions, price increase similar to the current rate. Here also the number has gone down. Earlier 19.7% of the respondents said that the prices are going to increase similar to the current rate. Now lower percentage are saying that the prices are going to increase similar than the current rate. No change on prices also, the numbers have been lowered. Prices decline, the numbers have been lowered. 5.1% people are saying the prices will decline. Similarly, the price will increase less than the current rate also decline, which clearly says that for food product, there is a clear indication that the prices, the expected inflation is going to go high. Similarly, if you go for services also, you'll find that, let me just go to cost of services, it kind of gives a similar indication, right? See, it's the same, predictions are being shown here. It gives a similar indication. So if you look at other household durables also, you will find that similar trends are, there is a little bit of change here, but mostly the trend is prevalent in cost of services and cost of fruit products. The prices are going to increase. So this is one of the findings of the study, which is pretty interesting, and it resonates with the household inflation survey finding. Now come to the another aspect of inflation, which also gives us very interesting insight. This is a heat map where the respondents were surveyed in various cities, and they have been asked what is the inflation that they are going to see in 1 year down the line, right? So this chart, if you see, it's from May 2017, and it's for November, and this is the end is November 2023. Now, what it gives you a flavor as to how different people in different cities view inflation. Now, in order to see the strength in greater granularity, I can choose a time scale zoom out from, and let's choose a time scale of quarter. Now, if you see a quarter, you will find that in earlier time frames, in 2013, 2014, the expected inflation in the various cities were pretty high. And it resonated with what the outcome of the real inflation was. Like if you look at this, here the inflation, because this is the portion which I was showing you, the inflation was actually higher. So there was this particular study clearly reflected the fact that the people, look at this, 2013 financial year 1, 2, 3, 4, right? All the cities. Some of the cities, there were the surveys were not conducted, and these are recent surveys, therefore these are being shown as green, but rest, if you see, all red, all over the places. Now, if you look at the current month, let me do a month, then the things will become much more clear. Now, if I do a month, and if I increase the window, the time units in the window, and make it 120, let's say, you will find that the trends of in some of the cities they predict lower inflation, but in most of the cities, right, in most of the cities they are predicting higher inflation. The numbers are high, like Thiruvananthapuram 9.99, Ranchi 10.12, Nagpur 10.16, right, 10.60, sorry, and then in some cities it is lower, but it gives it kind of a trend that in this period from December 16 to March 20, then there was a lot of cities where the numbers were low, but some cities like Ahmedabad, there is a persistently high expected inflation, and there have been very, very small periods where the expected inflation is low, but most of the cities, the expected inflations were high in Ahmedabad. But it kind of gives you a trend where the cities are, where the people in the various cities are looking towards expected inflation, which is a very interesting part of the study. And then we can do a category employment also. See how the daily workers are perceiving inflation, how the financial sector workers are perceiving inflation, homemakers, other employees, retired person, self-employed person. So if I do a zoom out and do a quarterly time scale here, that will give a better picture what is going on. So if you see here that retired person are somehow concerned more, and they were much more concerned in Q4 2023, but they are less concerned now, but still these numbers are higher, right? So so this is another trend which is very interesting to see. And the earlier period from FY13 to FY15, almost everybody had expectations of higher inflation to the extent of 16%. Now the numbers have somehow mellowed down, but still the inflation, the danger of inflation is still persisting. It kind of gives an impression that the people are expecting higher inflation. Then you can do category of age, how the various people at different ages are perceiving inflation. Now if you see that, if I do a month level month time frame zoom in, so you will see that here you will find that this is from December 13. Now this particular period, so there has been a slight tendency of people at the higher age to perceive inflation as a real danger, though people at the lower age tend to take more risk, so for them inflation is not an issue. But on the higher age people are perceiving, and these numbers have slightly increased here for the earlier month, which kind of resonates with what the trends are reflecting. Then in the last, I would also look at the curve, what we see here, how the curve, the real inflation numbers have changed over a period of time. You see, this is a general index of inflation starting from Q4 2014. See, numbers have undulated. It was 8.25, the general inflation, and it basically went down, and then it went up in FY20, and then it kind of remained up, over a period it went down, up. Now, the numbers have been showing, going down, but given the perception that the inflation is going to remain high, or the one-year inflation is going to remain high, that kind of gives us a little bit of a concern that this number may not sustain for a long period of time. Or if the inflation come out to be lower than what the prediction has been, then what is happening is that you are pricing the assets much more cheaper right now, because your expectation of inflation is higher and the actual numbers are going to be lower. Then you are purchasing assets, because you are valuing the assets cheaper, because you will be discounting those assets with a higher discount factor, and if the inflation number comes down compared to what your expectation is, then you have to pull down the price of the assets, right? So anyway, so that those changes in the market, as I told you, will kind of create more perception of risk, because you will not be certain whether inflation is going to be higher or lower. So it is always better that the inflation is aligned with the expected inflation. Then only the prices of the assets are correctly factored in, and which kind of makes the economy stable. Otherwise, there will be always shock in the economy, and therefore it is important to contain inflation as we go forward. And that's a very important job for not only RBI, but everybody, every stakeholder who is involved in this game should be responsible for containing inflation, managing the supply chain distortion, and demand on goods and services has to be taken into consideration, so the inflation does not go very high. So that's in short that I wanted to discuss about this video. Hopeful, and I hope that you like this video, and leave me your comments in the description section, and I'll come back to you later with another video. Thank you very much. Thanks a lot.